Hi, everybody. We are back for our third installment here related to fractional reserve banking. And in this segment, we're going to just take a brief look at two case studies, one regarding monetary policy responses by the Federal Reserve during the Great Depression, and then we're going to look at lessons learned and a reapplication of monetary policy during the Great Recession, during the housing crisis that we came through in 2007, 8, 9. And that we are still somewhat recovering from. Recall in the last set of videos, we were able to relate the money supply, the monetary base, and the money multiplier in the following way. So the M on the left side of the equation here is the money supply. Okay, the terms in the brackets, okay, that whole term in the yellow rectangle there, that is the money multiplier. And note that the multiplier itself, again, is being determined by two factors that the Federal Reserve or the central bank doesn't really have control over. And these are factors that capture the behavior of consumers deciding to hoard cash versus depositing it in banks. And that's determining the currency to deposit ratio. And the reserve to deposit ratio is a behavioral variable that is really determined by the banks themselves, not the Fed, but the member banks. So the Federal Reserve does not have control over these elements. What the Fed does control directly is the base. Okay, so if C over D or R over D increase, it causes that entire term in the orange rectangle there to shrink, which would cause the Fed to lose control of the money supply unless it adjusts the base in the opposite direction. Okay, so we're going to just take a really quick look here into a case study related to the Great Depression. So just a little bit of background here. The Great Depression was an economic contraction that lasted between 1929 and 1933. During this time, the money supply fell by 33%. So we lost about a third of the liquidity in the market here. Okay, at the same time, real GDP, real production fell by about the same amount, about 31%, and unemployment skyrocketed from 3% up to 25%. So this was a pretty serious time for the economy. Okay, what made things worse, in addition to the stock market crashing here, is that the banks also went through a liquidity crisis because people were not confident in financial institutions. Individuals didn't really want to hold as many deposits, so they started hoarding cash. And the banks at the same time worried that everyone was going to come and try to get their money, get their deposits out of the banks. The banks increased their reserves in response to the fear that the banking system was going to run out of liquidity. During this time, the money multiplier wound up shrinking from 3.8 to 2.4, due to both increases in the currency to deposit ratio and in the reserve to deposit ratio. And as a consequence, the money supply wound up shrinking even though the Fed tried to increase the base during this time period. So if we look at just the multiplier first, okay, over time here, okay, we can see that the drop in the multiplier is primarily driven during this time period by the increase in the currency to deposit ratio. Now note the reserve to deposit ratio also increased. Both of these factors drive that multiplier, that term in the orange rectangle, down. It causes that to shrink, meaning if we do not adjust the base, the money supply will shrink in response and there will be less liquidity in circulation as a result. Okay, so the primary driver in the Great Depression here was really consumers hoarding cash, causing C over D to go up, less depositing, more cash that they were holding, more currency in circulation. We can look at the money multiplier here, and we can see that in response to the increases in the currency to deposit ratio and reserve to deposit ratio, both increases in those ratios cause the money multiplier to move in an unambiguous direction, and that is down. Okay, so it dropped from a value of about 3.6, meaning every dollar printed generated $3.6 of money supply, down to a value of 2.4. So in terms of what happened to the money supply, well, we know if the multiplier drops, this typically causes the money supply to drop unless the central bank responds by increasing the base. Now you'll notice here, it looks like the central bank did not do that enough because the money supply was still going down. And if you look at the size of the base, it looks pretty stable over this period, 1931 to 1933. There is a slight upward slope in the base, meaning the Fed did try to kind of lean against the wind. And despite the fact the multiplier fell, they did try to increase the base, but they really underestimated how aggressively they would have needed to do that. Okay? So again, the money supply, this fell due to the actions of the public and the commercial banks. Really, the fall in the multiplier was not the fault of the Fed in and of itself. However, historians blame the Fed for allowing the money supply to fall and not aggressively increasing the base enough. Counterfactually, the argument has been put forth that if the Fed had increased the base more aggressively, this could have prevented the Great Depression from being as severe as it was. Fortunately, in more recent times, we went through the 2007 to 2009 financial crisis, we ran into a similar type of situation in that we had a relatively high money multiplier. Okay, but during this time, there was a bit of a liquidity crisis coupled with the stock market crash, coupled with the housing market crash, really. And again, this caused people and banks to be a little bit more cautious about using the financial system. So there was a little bit of cash hoarding behavior going on the consumer side, and a lot of reserve hoarding behavior going on the side of the banks. Okay, so from August 2008 to January 2009, the Federal Reserve doubled the base to $1.7 trillion. And despite that, the multiplier still fell to 0.9. Okay, meaning the multiplier was actually a divider rather than a multiplier. If the multiplier is 0.9, that means every dollar that's printed actually only increases the money supply by $0.9, which is a very weird and atypical type of situation. Okay, so here was what was going on. Now remember, the Great Depression, the increase in the reduction in the multiplier during the Great Depression, that was primarily driven by the currency to deposit ratio increasing due to consumers hoarding cash. However, you can see in the Great Recession situation, the more recent scenario coupled with the housing crash here, that the drivers of the shrinkage of the multiplier are a little bit different. The consumer behavior was fairly constant, and that C over D didn't change too much. In fact, it looks like that went down a little bit. However, banks did something known as hoarding excess reserves, and their reserves actually increased above their deposits. So the banks were holding more money than they actually needed to pay back their customers because they were worried that other banks might not and may need to take loans out to make up for the liquidity shortfall here, the lack of funds available. So again, slightly different picture here than in the Great Depression. During the Great Recession, the shrinkage in the multiplier was primarily driven by an increase in the reserve to deposit ratio. And we can see there is a very sharp drop in the multiplier that matches the time period by which the reserve to deposit ratio had jumped. Okay, so the big question here is, did the central bank learn its lesson, from the Great Depression? And the answer here seems to be yes, in that despite the fact that the multiplier took a dramatic drop, the money supply actually wound up increasing, and that's because the Fed this time learned their lesson and was extremely aggressive with their expansion of the base. They were extremely aggressive with the expansion of the base here, preventing that money supply from falling. Okay, and this kept the recession from bottoming out too low, from becoming too severe here. Okay, so again, the initial increase in the base, this was due to the Fed's emergency lending programs. Okay, these things included things like the term auction facility, auctioning loans to banks, primary dealer credit facility, loans to investment banks, these emergency lending programs, bailing out AIG and Citibank. All of these things wound up pumping more money into circulation, increasing the base. And as the loans were repaid, which typically works to diminish the base, The base continued to grow despite the repayment of these emergency loans because the Fed engaged in some quantitative easing and was really aggressive in buying up government bonds, government treasury securities, as well as government-sponsored entities related to mortgage-backed securities in order to try to prop up the housing market. So this is just a little brief discussion here, looking at this case study of the central bank's response to the Great Depression and the lessons that were learned when we were in a similar situation recently during the Great Recession, whereby the Fed learned its lesson and was very aggressive with the expansion of the monetary base to prevent that dropping of the money supply. Stay tuned for more videos regarding fractional reserve banking. We're going to start jumping into the liquidity preference theory and then thinking about applying that to the idea of whether or not the central bank is actually targeting interest rates or trying to target the money supply directly. So I hope you enjoyed, and we will see you shortly.